The struggle is real. Everything moves in the same direction at the same time. This here is the altcoin market in the last year. Bitcoin wasn't too great, and so the altcoin tended to crash more. But this is not just specific to the crypto market. We've got the same in the stock market. So for example, here we've got Amazon in light green, Meta in blue, and Google or Alphabet in darker green. Stocks tend to go up and down at the same time. This is called correlation. And that's usually because there's a common risk factor across those assets. So let's say there is less risk appetite for technology stocks, then they tend to go down. When everybody gets hyped about technology, then everything goes up. And that effect is very strong. Now, the conventional solution to this is to buy different asset classes. So to be diversified, to own things that don't share common risks. So that we have got some property, we've got some gold, we've got some crypto, maybe some other stocks that are not technology related. So you just buy different things, and because those different things don't go up and down at the same time, but they move in different cycles, we tend to reduce the ups and downs of the overall portfolio. So that's the common wisdom, right? There is asset class A, so let's say that's crypto. There is asset class B, that might not move exactly the same, that goes down and up at different points in time. So let's say that's property. And the resulting portfolio that we get from that tends to move with a bit less volatility. Now, while this is a viable strategy, I think we can take it a step further, because this approach here says that we go long, that we bet on rising prices of every asset class all the time. Now, there are points in history where everything tends to go down at the same time. So for example, during COVID, we had a massive liquidity crunch. First, it was the stocks that sold off. Subsequently, we even saw gold getting liquidated. So the gold price went down as well. And then in the end, crypto followed. The only asset that did okay was fiat, right? If you had your money in fiat currency, you were able to buy the dip. But if you were in any other asset class, you tended to rather lose purchasing power. Hi, my name is Gerhard. I've been in the investing game for the last 8 years. I hit my first million 3 years ago. And in this video, I want to share the approaches that they don't teach you at university. I actually have a master's in financial analysis and investment management. But even there, once a topic goes beyond just discounted cash flow analysis, there isn't much discussion anymore. If you want to have a look at my track record, on average, I outperformed buying and holding Bitcoin by 2% per month in the last 5 years. So that's my portfolio value measured in BTC. And here is the monthly ups and downs. There are winning months, there are losing months, but in the end, the long term matters. Again, more details are down below in the pinned comment. So let's have a look at those more advanced strategies. What we see here at the top, that's TLT. That's a long-term government bond ETF. What we've got at the bottom, that's the NASDAQ 100. Now, obviously, we want to hold the NASDAQ 100 over just bonds over the long term. They performed much, much better. But maybe we can even engineer a portfolio that pushes returns even higher while reducing volatility. Introducing the long NASDAQ 100 short TLT portfolio. So that's what we see here in green. We are betting on rising technology stocks and on falling government bonds. So fundamentally, we are making money in two ways here. When the economy expands and gets more automated via AI, technology stocks go up. At the same time, while the debt burden globally goes up for all governments, we are making money with shorting bonds as well. For example, check out this here. The crash in 2022. Technology stocks went down by 36%, but this mixed portfolio of going long technology stocks and short bonds, it had much less volatility. It just continued to creep up. So we've got the same kind of performance, but less volatility over time. Better return, less price risk. That's exactly what we want. We are diversifying here. We've got exposure to tech stocks and we've got exposure, negative exposure, to bonds. So the risk profile is very, very different. There are no common, or let's say less common risk factors across those asset classes. We simply just position ourselves in a way where we think this asset class will go long term. In other words, we do not have to subscribe to the idea that we have to buy everything. Maybe we do not like a particular asset class. And instead of buying that, we just get exposure to the exact opposite. We short that asset class. It's a very uncommon way to diversify a portfolio, but I think it's very effective. Diversifying means reducing volatility. And clearly we do that with the Nasdaq relative to long-term government bonds. There is less volatility here. Yet with this approach, we get the same kind of return. And that's usually not the case with diversification. Usually we tend to get less return because now our winners get diluted with things we don't like as much. So let's take this a step further. Let's have a look at the top asset in the S&P 500. So you might have already watched the related video. This is a comparison of the S&P 1 versus the S&P 500 over time. So we just buy the largest stock in the US instead of buying all 500 stocks. And if you did that since 1990, on average, you would have outperformed buying and holding the S&P 500 by 7 percentage points per year. So you would have almost 10 times as much money compared to just buying the S&P 500, simply by just buying the largest stock. Right now, that largest stock is Nvidia. And so check this out. This is Nvidia relative to TLT. We go long Nvidia, we go short long-term government bonds. And here is the Nvidia price itself. Note how Nvidia in isolation can go down by 67%, but Nvidia relative to TLT went down by only 50%. Still a meaningful drop, but still less than Nvidia directly. We are getting diversification benefit here without reducing our overall portfolio returns. Well, have a look at this approach over here. This is Bitcoin at the top and the gold price at the bottom. Maybe we aren't that bullish on gold anymore. This is the long-term ratio of gold relative to the US money supply, a chart that starts in 1960. Let's say your thesis is that gold is rather underperforming going forward. Maybe it's going back to its long-term equilibrium. Maybe it's going to underperform the monetary base by 40% over the next years. Let's say that's your thesis, and I think it's a very reasonable thesis. Instead of buying Bitcoin directly, so that's the long-term Bitcoin price, let's say there is upside of roughly 88%, you could buy Bitcoin and short gold at the same time, which might have more upside, which might go up by 147%. I'm connecting here the exact same tops, by the way, right? Those tops are aligning the same way as those tops align. There is more upside for Bitcoin relative to gold than for Bitcoin in isolation. If, of course, Bitcoin does what it used to do during prior cycles. We have to always work with one thesis. Even though we can't be certain where something moves, we have to position ourselves in one way. And the message of this video is that that positioning does not necessarily have to be long all the time. Diversification does not mean that we have to buy gold and buy Bitcoin at the same time. It can mean that we short gold and buy Bitcoin at the same time, or vice versa. We can diversify simply by being exposed to other asset classes, but that doesn't mean that those asset classes have to all be long exposure. Now, most people never set up their portfolio that way, but I think it's a mistake. Usually that's out of convenience. Probably you've never shorted an asset in the past, or maybe you've shorted cryptocurrencies, but you never shorted the gold price, for example. But it's actually relatively straightforward. Let's say you use Interactive Brokers, for example. You can simply set a sell order on a gold ETF without owning the gold. That way you will have a negative balance, you will own negative gold ETFs, and when the ETF goes down, you will get profit in your account. So you don't have to do anything fancy. You can simply just hit the sell button when you don't own that particular asset. The only important thing is that you've got your risk profile set up properly. So there are these regular questionnaires. You have to say that you're an advanced investor and that you understand the things that you're doing. I'm going into much more detail in the tutorial videos of this channel. So that's in the premium membership. Link is down below in the pinned comment. But I'm also sharing my real-time crypto trades. And I'm publishing the history in real time. All of those trades can be 100% verified, so there is a Telegram post for opening and closing. So let's have a look at this Luna short. I opened the position over here based on a backtest that I made, and subsequently I closed it over here. And so that verification can be made for every single trade, and that's the historical performance. So 5.3% per trade on average over 173 trades starting 2 years ago. I don't see many people that are willing to share their performance this way. That's, I think, where this channel is different. And so if it's your very first time here, feel free to subscribe. I publish here regularly. A like would be very much appreciated as well. It helps the channel grow. See you next time on YouTube or see you on Premium. Link to Premium pops up here on the screen. There's also a 7-day money back guarantee. So in case you don't like the content, just message me within the first 7 days and I'll refund you. No questions asked. See you next time. Cheers.